If you like big round numbers, well, the Dow Industrials, they just gave you a reason to celebrate. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Alex Steele. Do you like round numbers?
I do. Not 40,000. I kind of prefer 50, 100, So, I don't know, wake me 10,000 points from
All right, fair enough. I mean, let's be honest. A lot of people are going to be like, yeah, Dow, whatever, no one cares. But I do. The S&P 500 is, again, at a record high. We're obviously off the highs of the session. But for the Nasdaq and the Dow, still sitting at a record. What I found interesting about what was moving the Dow to that 40,000 was the stocks within it. One was Walmart, obviously, earnings really good. Those high-end consumers actually going to Walmart. But the other was 3M. That's an industrial company. Vertical Research upgraded the stock, saying that they're very positive on margins and growth under the new CEO. I just think that that's really interesting. Consumer discretionary and industrials. And then just our random check-in here on the bond market. 2-year yield up 6 basis points remain. The equity market unfazed by that higher bump.
Yeah, despite, of course, the 40,000 level here, yesterday's rally to those record highs, at least kind of on pause today. You saw that on the screen there, pretty much unchanged. Some modicum of profit taking from yesterday and some digesting as well of the latest economic data. We did have numbers out today for new U.S. home construction, and it did show growth in April. Less than forecast, and permits to build new single-family homes, that actually showed a drop for a third straight month, down to the lowest levels that we've seen going back to August. This after it was trending higher at the end of last year. The home building index, at least as measured by the S&P 1500 index, down as much as 2% here on the day, with all 16 members trading lower, and that includes installed building products, D.R. Horton, as well as Toll Brothers among the hardest hits. In addition to the housing data, there was also that report on April import prices for the U.S., which continued to rise, including for core consumer goods, despite evidence of core goods disinflation in that April CPI print from yesterday. So what does that all mean? Well, while import prices tend to be volatile and don't always translate directly into CPI and PCE, the numbers really didn't offer much encouragement that inflation is still on a downward trajectory. Cleveland Fed President Loretta Mester said as much today without directly referencing the numbers, as did Richmond Fed President Tom Barkin. So what's the fulcrum point then? Maybe it is wages that are proving to be the difference between a temporary rise in inflation and one that gets firmly embedded and knocks a disinflationary trend off course. There's a new study out by former Fed Chair Ben Bernanke and former IMF Chief Economist Olivier Blanchard that makes the case that central bankers still need labor markets to cool if they're going to traverse that last mile of the inflation battle back down to 2%. Bernanke and Blanchard saying that as the shocks to other prices like food and airfare have finally started to reverse, the wage pressures for hot labor markets have become a more important source of inflation, Alex.
And that's been the fear the whole time, right? That wage data will spiral out and you'll get that wage price spiral. For the equity market, though, my question is, when do we sell stocks? And do we ever at this point sell stocks? And this is one case for holding on to those stock gains. So this is the EA function on the terminal. I would definitely suggest you check it out. And this is a historical analysis of growth. This is average sales percentage growth, and this is average earnings percentage growth. Here is where we are, right? First quarter of 2024. And just look at the improvement that we're expecting on an earnings level, and even more importantly, on a sales level. Now looking for over 5% sales growth in the next year, in the first quarter of 2025. With this kind of bar here, Romaine, why would stocks ever go down? Legit question.
Yeah, legit question, and maybe we can pose that to our first guest here to kick us off to the close. Is Mimi Duff, Managing Director over at GenTrust. And we should point out, Mimi, and correct me if I'm wrong, but you've been overweight fixed income. Underweight equities, is that still the case?
Yep, we took, you got to take the overweight from somewhere, so we have shifted to underweight in the equity side.
Are you still comfortable with that, given some of the moves that we've seen in the equity space recently?
Yeah, well, I mean, we still have healthy allocations to equities. We're not missing this rally. We do feel that the overweight and fixed income will perform better in a range of outcomes if the economy does trip, or frankly, if we just continue to steady ahead, as we have seen. We think you're going to earn those yields on the fixed income side.
What would be the case to buy equities? Like, what would be the case? What would you have to see to kind of change that view?
Yeah, so earnings beat, right?
Yeah.
So if we continue to see reason to see further beats, if we were to see some of the the wage inflationary pressures coming down without deterioration in the rest of the economy, then I think that you can get comfortable of more of a soft landing. And I personally think that's what the markets were reading into with the last payroll print. It did very much look like a soft landing scenario, and we did see some improvements on the wage inflation side there too.
So does that mean that you don't see a soft landing, or you just feel like, you know what, nobody knows, and either way, fixed income's going to do it for me?
The latter.
Okay.
Nobody knows.
Well, at least that's honest, right?
Yeah, you're probably the first person to say that. And
totally.
actually, we appreciate that. But it gets to this idea, too. I mean, and obviously we know no one knows. But at the same time, people have to stay invested. They have to make those allocations here. I am curious on the equity side of things. Even though you are underweight, there's obviously something there that you feel is worthy of holding on to. Where and why?
Yeah, so within equities, we like broad markets. Obviously, the U.S. has been the leader, large cap, the tech, that's been the leader. So you really need to be owning allocations to that. We own diversified baskets. We also like infrastructure. That's been a winner for some time. We continue to hold that sector.
What about housing?
So housing is a bit tricky. I think it's a bit more muddled because the current home stock, the homeowners are in very good shape. But if for new homeowners, rates are very high. We're starting to see some of the numbers look more mixed there. I think that will play out over time. How long are we going to be at these higher interest rates? Effective rates for home buyers are north of 7% right now.
Yeah. I like the idea, though, that if you look through the noise, kind of, how do you hedge all those bets? And that's why I wonder about what your AI call is, because that's going to be a structural change no matter what. And there's so many different ways to play it. There's the NVIDIA, there's also utilities, there's building data centers, there's all different kinds of stuff that's irrespective of what the Fed's going to do. How do you play that?
So on the alt side in our portfolios, we do have exposure to data centers. You mentioned that. I think you're getting, again, it's the S&P 500 has a lot of that. But it's not just the tech players, right? Mm-hmm. It's the second order effects of how does the AI wave filter through to all the other industries and improve efficiencies. So you really do have to have a very broad net when you're looking at AI exposure.
And
right.
yeah.
Sorry, go ahead.
I was going to say, and then end up there. What about financials? So I feel like that strings all of the different, except maybe data centers, string it all together.
Yeah. So I think financials is an interesting picture, right? It's a story of winners and losers, right? Some of the biggest banks that, frankly, aren't even paying much interest on their deposits.
Oh yeah, I feel that.
Some of those names have done very well, but we're more concerned about the small and medium-sized bank where commercial real estate, that's residing on those balance sheets. And I think it's going to play out, again, over time as those refinancings have to occur.
I mean, one potential, I guess, silver lining of all this is that even if there is pain in the commercial real estate space, there are a lot of folks that look at it and they say that the elongated nature of this means that the contagion risk to other areas of the market and the economy might be more contained.
I think that's fair to say, certainly. I mean, the Fed is mostly concerned about consumer leverage, Main Street, not Wall Street. Yeah. And consumer leverage right now is just so much lower than it was, say, back in the financial crisis. So I think that's perfectly fair to say, especially if it takes place, if there's re-risking takes place over a long amount of time. Yeah. Maybe we can avoid having massive consequences to the full economy.
Absolutely here. And even though as some people try to look for some animal spirits in other pockets of the market, Mimi, always great conversation. Mimi Duff, Managing Director over at GenTrust, here to help kick us off to the close. Coming up here, we're going to hear from our interview with Jamie Dimon. He says he's more worried about inflation than the markets appear to be. We're going to have some other highlights from that conversation in just a second.
Plus, a read-through on global growth and the status of the Baltimore Bridge cleanup with John Wobensmith. He's the CEO of dry bulk carrier Genco Shipping.
And Netflix's push into advertising, well, it's providing a big payday for those programmatic ad platforms. Trade Desk up for the second day in a row, as is Magnite. We're going to talk to get some sell-side perspective here on those two names in our top calls, all that and more. Coming up in just a second, right here on The Close on Bloomberg.
season is here.
This is a get out the popcorn moment.
Across the board, just pummeling of expectations.
Earnings matter. That's really clear.
Bloomberg is first to break the numbers.
Hey, folks, we've got Microsoft.
Apple earnings crossing the wire.
Alphabet, wow, coming in way above expectations.
Hertz driving in the opposite direction.
A lot still to come.
With the smartest insights.
Meta's kind of damned if they do and damned if they don't.
Is this their iPhone moment? I view this as Operation Kick the Can to August.
Continuing coverage on Bloomberg. Context changes everything.
Well, guess what? Jamie Dimon is still worried about inflation. The CEO of JPMorgan and the chair sat down with their own Francine Lacqua at the firm's Global Markets Conference in Paris, and he explained that despite the record highs we've seen for stocks, he still expects price pressures to influence the economy for longer than many investors are expecting.
I wouldn't call it turbulence. We've had good, healthy markets for quite a while. They're kind of predicting a soft landing, and you see that in both stock prices, which are kind of high, credit spreads, which are kind of low, markets which are kind of wide open. That's all good. It doesn't tell you what the future is going to be. I mean, I can point a lot of times in history where that was true, and the next year it wasn't true, and so we'll see. I don't pay as much attention to monthly numbers as most people do.
I know. So what do you think the future is for inflation and interest rates?
I'm a little more worried about it. I mean, we've had very big fiscal deficits. And I think the underlying inflation may not go away the way people expect it to. And I look at the future, like a lot of things we look at are kind of inflationary. The green economy, the remilitarization of the world, the infrastructure requirements, the restructuring of trade, fiscal deficits. So I think there are a lot of inflationary forces in front of us that may keep it a little bit higher than people expect. So the surprise would be rates are higher, inflation a little bit higher, and maybe that'll slow growth. And obviously, geopolitics is a whole different issue. That could be determinative in what our economy does next year, and we're just not going to know.
But so does that mean you think it's 50-50 whether the Fed cuts or hikes next time around?
Yeah,
the next move?
I really don't pay that much attention to that. The Fed will have to follow the data, and I don't know what the data is going to say, but I think they are doing the right thing to be patient right now. See what's going to happen. They may not know for a couple of months.
But no big correction. I mean, if you don't pay that much attention to it, it means you're not worried about anything.
No, I'm worried. I just said stocks are very high, and I think the chance of inflation staying high or rates going up are higher than other people think. So I think the chance, my view is whatever the world is pricing in for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
In the U.S. or globally?
Well, I'd say in the U.S., but also that could affect globally, yeah.
And so what does that mean for markets?
They'd be down. And credit spreads would gap out.
So why is the market not pricing that in?
A lot of happy talk.
Where does that happy talk come from?
Low rates, central banks are going to reduce rates. Maybe the geopolitical things disseminate, don't cause problems, and so the future isn't predictable like that. So I'm a student of history. I've watched all the inflection points. If you go back, my dad was a stockbroker. I go back to the booming markets of 72 and the collapse of 74. The healthy markets of 80, the collapse of 82. The 87 market crash, the 1990 real estate crash, and almost all of them were not predicted the year before. So I look at these factors that drive these things. They're not always known. As a company, we prepare for all of it so we can serve all our clients regardless.
But what do you see as the main stress right now? Because if it's geopolitics, we talk about it. It's just not really priced in. Is it distress? Is it something actually going under that you worry about, or just multiple factors coming in at the same time?
No, I think geopolitics could create the main stress that we're worried about in terms of oil and gas prices, trade alliances. But I think the surprise would be higher rates because inflation didn't go down. That inflation has been stubborn, maybe bounces up next year. I think inflation next year may be in the cards. It may have nothing to do with what you're seeing today. So that to me is the surprise. If you had higher rates and God forbid stagflation, you'll see stress in real estate and leveraged companies and some private credit and things like that.
All right, CEO at JPMorgan there, Jamie Dimon, speaking with our very own Francine Lacqua. And I thought it was interesting. I mean, we've heard these kind of comments from Dimon before, but I thought it was interesting he talked about, in his view at least, the disconnect between what he views as inflation risk and what the market apparently isn't viewing as a risk, or at least maybe they're just whistling past the graveyard.
Or that next year we could see inflation, regardless of where equities are trading right now. And I feel like the elephant in the room in that conversation in some ways was fiscal. that like we have so much money coming out of the government that kind of no matter what, that's going to float its way into the economy. And I wonder if that is also cause for inflation worries next year.
And that fiscal stuff is structural. I mean, he obviously mentioned fiscal specifically, but then you talk about, he referenced the Inflation Reduction Act, the spending on semiconductors and some of the tariffs and things like that, that of course are all in theory, permanent and structural, and then you lay that over some of the more transitory things like wages and stuff, and I guess I could see why he would make a case for being concerned.
Which is why it's so interesting why we would have then cuts in that environment, where you have growth and you have all that fiscal spend, and then you get cuts. And I can see why people would scratch their heads.
And I think Jay Powell and folks are also scratching their heads as to why the market keeps pricing that in here. But of course, I mean, we still got a few months, a lot can change, and maybe the Fed will come around to the market, or maybe the market will have to come around to the Fed. In the meantime, we're going to focus on some of the big movers today. Netflix yesterday announced plans to launch an in-house advertising unit. The big beneficiaries of that might be the third-party operators. That includes Trade Desk and Magnite rallying once again here on the day. We're going to dive a little bit deeper into that when we come back after the break. This is The Close on Bloomberg. All right, let's get a view from the sell side with our top calls. The big movers on the back of analyst recommendations. And we start off with Occidental Petroleum, a downgrade to hold over at Truist, which also trimmed the price target to 69 from 85. While the analyst is expecting the oil and gas company to have a solid second half, he also expects minimal shareholder return in the coming quarters. This after the acquisition of Crown Rock, while Oxy uses the majority of its free cash flow after that to reduce debt down to about $15 billion or less. The share is fractionally lower on the day. Next up, let's take a look at Wayfair. Argus Research lifting its recommendation on the e-commerce company to buy from hold home furnishing sales. They started off the year weak, but that shouldn't be a problem for Wayfair, according to the analyst. He expects Wayfair to benefit from growth in online orders and its active user base, given its broad selection of furniture and home goods. Nevertheless, Wayfair's share has taken a leg lower, down about 3% on the day. And finally, an upgrade for pet insurer Trupanion. Bank of America raising its rating to buy on the hopes of material improvement in operating margins. He reminds investors that insurance is a cyclical industry, meaning a period of under-earning usually quickly translates into over-earning over the next 18 months. Those shares rallying 20% on the day, and those are some of our top calls. All right, we now want to turn to the world of entertainment and, more importantly, the world of digital advertising. Big news from Netflix yesterday with the streaming service announcing plans to launch its own online ad business, but it's going to need the help of some third-party advertisers like Magnite, like Trade Desk. Both of those stocks rallying for a second day. Magnite up more than 20%. Trade Desk having its best two-day run going back to February. This is a huge positive for Trade Desk, according to our next guest. And he joins us right now to talk a little bit more about this. Ygal Arounian joining us. He's Director of Research over at Citi. He's got a buy rating on Trade Desk shares. All right, let's talk a little bit about what this actually translates into in terms of revenue for Trade Desk. Have you mapped this out already, Ygal?
Yeah, so we've mapped it out a little bit, and our expectations are that this can drive up to 400 to 500 basis points of incremental growth in 2025. So we're not going to get much of an impact this year. It's going to launch later this year at the end of the summer. Take some time to ramp up. But we think this can be about $500 million of billings for the Trade Desk in 2025. Now, the Trade Desk doesn't capture all of that. So those are ad dollars that are run through its platform. And then its average take rate on that is about 20%. So that's 300 to 400 basis points of incremental growth in 2025.
Yeah.
But Netflix is still really early in its advertising push. And Netflix ad dollars are going to continue to grow at a pretty rapid pace over the next couple of years as it scales that part of its business up. And so that can contribute even more in 26, 27 and beyond.
Well, that's what I'm curious about when we talk about the evolution of connected TV and over-the-top TV and how it all sort of blends together, and how Trade Desk and some of these other companies are kind of at the center of that. You seem to be suggesting that we're still in the pretty early innings of this cycle here. So that would seem to suggest that growth rates, at least longer-term growth rates, could actually accelerate from where we're at right now?
Well, growth rates might not accelerate as total ad dollars get bigger. I think there are factors that can keep growth rates elevated for a long period, even as the size of the pool gets bigger. So, and if you look at the transition of viewership from linear TV to streaming TV, we're at about 50-50 now. And, linear TV, a lot of people would agree, is essentially broken more or less, and that pie is going to continue to decline. Ad dollars so far have trailed that. Right? Linear TV advertising is still about a $140 billion dollar pool globally. Streaming TV this year is going to be about $40 billion. And so we're not on a one-to-one basis there yet in terms of ad dollars, but we're there in terms of viewership. Viewership is going to continue to shift to streaming and CTV, and ad dollars we think are going to continue to catch up. And that's going to benefit the streaming industry, and is with the Trade Desk as a key kind of pipeline from advertiser dollars to the networks and the platforms. They're right there, centered really well to capture that opportunity.
Ygal, who are the main competitors to Trade Desk, and sort of how might Trade Desk outmaneuver them, or maybe deficient in other areas in relationship?
Well, one of the things that we really like about the Trade Desk is that its position in the market, they are essentially unrivaled. So the biggest real competitors is to what the Trade Desk is, which is a demand-side platform, that connects advertisers to the networks. And CTV is about 40% of Trade Desk's business today. The biggest competitors are those that are closed platforms, and that's Google, DV360, and you saw Netflix announce that they're also going to be a partner here, along with the Trade Desk. Amazon has a really big demand-side platform in video, but again, that's mostly focused on Amazon. We don't know the specific numbers for Google, but Google also is likely mostly focused on Google inventory and YouTube today. And the thing that differentiates the Trade Desk is that it's really open across the web. It's not within this walled garden. So, and it is truly independent. It doesn't own any of its inventory. And they are really unique in that world in terms of their size and scale.
Ygal, thanks a lot. Super appreciate it. Thanks for jumping on. Ygal Arounian over at Citi. Thank you very much. I wonder, if I buy an ad on linear TV versus, say, Netflix, I'm going to pay more for that ad, right, on linear TV. When does streaming sort of outpace that?
I think it's getting there. But that's what I'm curious about. I think some of it is it's so fragmented right now that you're not seeing the same, apples to apples numbers. But as you know, just based on your own viewing habits and everyone else's, it's just a matter of when, not if.
Yeah, you would think. Yeah. Considering how much time I spend on Amazon or whatever. Okay, anyway, coming up, we're going to take you back to the supply chain issues that were caused by that Baltimore bridge collapse and see where we are now. John Wobensmith is president and CEO of Genco Shipping and Trading. He'll be joining us in studio to give us an in-depth look at the supply chain. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. And my question is, what stops the equity market? So what has the power to disrupt stuff? You were talking about wages.
Yeah, and wages, but then it's also, I guess, I don't know if we call them black swans, gray swans, but you have these potential disruptions that come down the pike every now and then. And that can prove to be inflationary. And we had that just a few weeks ago.
Yes.
Now, it may have subsided, but that is kind of the risk, right?
Yeah, exactly. And that's exactly what I was going to take it, was what happened in Baltimore at the Francis Scott Bridge when that collapsed, right? That had the risk of becoming inflationary and further disrupting supply chains. Luckily, it did not do that. And earlier this week, crews successfully used controlled explosives to break down parts of the bridge following that March collapse. Now, that temporary access channel has been set up with hopes of returning to full operations by the end of May, which, quite frankly, is amazing speed to get something like this done. So we wanted to get some insight on sort of the repercussions of that, where we are in the supply chains, how the inflationary environment is shaping up in that industry. And joining us for more is John Wobensmith, President and CEO of Genco Shipping and Trading. John, good to see you.
Yeah.
Thanks for joining.
Yeah, thank you for having me.
Were you surprised it took just a couple months to start clearing the port?
Pleasantly, yes. Yeah. It's obviously an amazing feat, and I don't think anybody knew how long it was actually going to take. From what I understand, they're actually going to have the ship out from under it from 3 to 4 days from now, and actually alongside. And we had there was the first coal shipment that took place last week. And once the ship is out of the way, we expect early June, and we're already seeing June requests for shipping on the larger Capesize vessels for coal. And there's still a lot of coal on the ground. You have 1.5 million tons that's sitting there from backup that needs to be moved rather quickly.
It is really amazing though that didn't have like a longer term effect or kind of cloud over, I don't know, supply chains, inflation, etc. What are you noticing? I mean, you're a dry bulk shipper. Like you ship things like steel, coal, like all that good stuff. What are you seeing in terms of, say, growth and inflation?
Well, I mean, certainly there have been, well-publicized issues with the Panama Canal, and then and the low water levels, and then after that, obviously the issues in the Red Sea, which still persist today, and that is definitely inflationary, particularly with dry bulk commodities, because for the most part, most ships are now going around. And going around South Africa and avoiding the Suez Canal and the southern Red Sea in particular.
So, I mean, if you're going all the way around the Cape of Good Hope or whatever, I mean, how much extra does that add to
12 to 15 days. And if you're actually avoiding the Panama Canal on top of that, you're talking about another 12 days. Though the Panama Canal is starting to ease up, the water levels are starting to get a little better, so there are a few more ships that are transiting. So
the price adjustments that we've seen to account for that here, do those prices stay, or when we start to see a normalization in shipping routes, both here in the U.S. as well as overseas, do they snap back?
Well, first of all, I don't think the Red Sea and avoiding the Red Sea, that's not going to go away anytime soon. I see that lasting for at least another 12 months. So yeah, I mean, well, look, it's obviously geopolitical and it depends what's happening there. But, right now I don't see why any ship owner would want to risk their crew putting them through that situation. So I see that lasting for a while. The Panama Canal, on the other hand, we're now up to 27 vessels. The normal number that would go through there is 40. There still is an auction system, though, so you can't just show up and go through. You have to participate in the auction, which is anywhere from maybe $100,000 to $200,000 just to get in the queue. And so that is inflationary itself. We've had 2 voyages go through there over the last few weeks, going from west to east. So it's getting better, but not quite there yet.
Just randomly here, copper prices have surged recently on the short squeeze, and the ARB was really like go long Shanghai and short the U.S., and that ARB has really unwound, and now I've been reading a lot about a flurry of traders in China trying to get material into the U.S. to take advantage of those high prices. Are you seeing that? And are the ships available? Like, is that doing anything for you?
Yeah, we're seeing a little bit coming off of the west coast of South America, and then again going up into the U.S. We've done a few of those shipments.
And is it really expensive to do that? Like, are prices high? Is the demand really there?
Well, again, you have to go through the canal, right? So you've got that extra cost no matter what in order to do that. But when you're looking at the price of the commodity, it probably makes sense.
I am curious about the demand side of this, and I was taking a look at container shipping rates, a little bit different than what you guys do, but I was seeing those prices were up significantly in the most recent week, another 10%. Now, some of that's good because it seems to suggest that economic activity is picking back up, at least for the goods that consumers buy. Are we seeing, or do you anticipate a pickup in economic activity for the types of goods that you're shipping, the dry bulk goods?
Yeah, so we're cautiously optimistic on Europe entering a recovery stage. I mean, their steel production has really, it's been negative. It's been the only negative steel production actually worldwide. India's been very strong. China continues to be strong, but Europe has lagged. And so we see that starting to normalize, hopefully by the end of the year going into next year.
Longer term, with all of the efforts at reshoring certain types of things and trying to find other sources of raw materials that aren't necessarily either coming from China or for some African nations. And I know that's a process that's going to take years, if not decades, to play out here. But how do you sort of, I guess, adjust for what could be, I guess, effectively changes in what gets shipped and where it gets shipped?
Yeah, so new trade routes, I would say, in dry bulk are relatively rare, but one of the big trade routes that has been now created is the bauxite trade out of West Africa. Most of that is going into China. And before, the only thing that was really happening in the Atlantic was iron ore out of Brazil going to China. So now you've got 150 million tons a year that's coming out of West Africa and going to China. So that's a trade route that's really developed over the last few years. Baltimore, though, shipping coal out of off the east coast of the U.S., It's not a new trade, but it has grown. India has really started importing a lot, particularly the metallurgical coal for their steel industry, but also thermal coal. Some of that's coming out of Baltimore. Some of that is definitely coming out the East Coast. So we've seen growth, not necessarily a new trade route, but those are the types of things that we contend with and try to set ourselves up for.
Before we let you go, if you were to rate China's growth right now, what would you rate it as?
In terms of GDP growth, or
like
in terms
from what you see, like is it an A, is it a B, is it a C? Like what do you think?
So this is a this is a complicated question in the sense that our view is the housing market still has big time problems, and that is certainly a consumer on the steel side. But we've seen steel exports, they're up 20-30% this year. Most of that's going to other areas in Asia. We see steel production as healthy. We don't see big growth rates coming in steel production, but we see it relatively flat to maybe up 1% to 2% over last year. That goes into the iron ore trade. The iron ore trade's been doing very well the first part of the year. Typically, it does even better in the second half of the year on the back of China. And I mentioned that bauxite trade. And India is going like gangbusters on imports right now for dry bulk.
All right. Well, this has been very illuminating. You've been doing this for a lot of years, and I was just told. Oh no, I give him a compliment. Hey. That's the induction into the International Maritime Hall of Fame for your whole career and everything that you've done in that. So congratulations on that.
Thank you.
And John, great to have you here. John Wobensmith, President and CEO of Genco Shipping and Trading. Alex.
All right, coming up, you got a look at Chinese tech names as shares of Alibaba, JD.com, and Baidu rise amid mixed earnings reactions. More on that in the stock of the hour coming up next. This is The Close on Bloomberg.
The Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
All right, it's time now for our stock of the hour, and it's a closer look at several stocks in the Chinese tech space here. Global investors, they have been cautiously returning to those Chinese stocks. We saw that in 13F filings from David Tepper. We saw that in 13F filings from Michael Burry, pushing the Hang Seng Tech Index up more than 24% just in the last 3.5 weeks alone. Abigail Doolittle joining us right now for a closer look at our stocks, plural, of the hour. Alibaba at the top of that list with a 7% gain, but this has kind of been unfolding for the last few weeks. A lot of people that kind of abandoned that Chinese tech trade, but it looks like it's back.
It looks like it's back, and I would say it's actually a theme over the last couple of years because we have China stocks underperforming U.S. stocks over the last 4 years. And if we take a look at a chart of the two of them, the S&P 500 up 80%, the CSI 300 down. Now, there's been lots of starts and fits in there where investors have thought that China tech and China stocks were investable again, but it simply has not happened yet. But we have this flurry of big investors coming out basically saying that they think that there's going to be some activity here for these China stocks. Michael Burry, who is, of course, well noted for the Big Short and shorting the housing market in the GFC, he doubled his position, albeit small position, but he doubled his position to Alibaba, doubled down in JD.com. Apparently, they just put up a good quarter, Alibaba less so. But the big question, is the macro in China really changing enough to support this? And I would argue we don't know. Like one of my sources who goes to China for real estate issues, or he's a real estate investor, developer, he has been there over the last couple of months. He said it's so much worse than what the media is reporting. Oh, wow. So it may not support the idea. They just don't seem to have gotten out of their own way since the pandemic. The recovery is not the same. And also what's really interesting to me is we now have President Biden putting additional tariffs on some Chinese goods recently, in addition to the former President Trump tariffs. I almost wonder if those initial tariffs, because they were pretty severe, if that's part of the reason why the Chinese stock market has not recovered. Because again, a chart, if you take a look, the S&P 500 going sky high, China stocks just not. So, but is this the real deal? I would say we don't know yet.
Have we noticed technically, though, when do we get to maybe breakout potential?
So it's interesting. I was just taking a look at one of the charts on either the Hang Seng or the CSI, and it is starting to break that downtrend. So there is a possibility that this is the real deal. But from prior standpoints, it did that before. So, it's not technically. I can see why investors from a technical standpoint, just purely technicals, would be somewhat interested. But here, if we take a look at this terminal chart, you can see all the false starts. Is this the real one? I don't think it's very convincing there yet that this is. I think that we need to know the fundamentals. We need to have more of a look into China and the economy to think that these companies are really going to get going.
Yeah, I was just taking a look at some of those technicals. I mean, you are seeing a little bit kind of above those longer-term moving averages, above those Bollinger Bands. So I guess maybe that is momentum. But to your point, too, I mean, of course, Bloomberg's written a lot about a lot of the issues still going on in the property market there, and China's still trying to get a handle on it.
Yeah.
All right, Abigail, thanks a lot. Really appreciate Bloomberg's Abigail Doolittle joining us. I guess the problem is if you're an investor and you want exposure to China, how do you do that? Because you can't do Apple now, right? That feels like a risky bet if you want a China exposure.
I don't know. It's funny. I remember having this conversation, maybe it was like a couple years ago, and it was so many of these big investors said, look, you don't need to buy a Chinese stock to get Chinese exposure. I mean, you just go through some of the big companies, and maybe it's not an Apple, maybe that is vulnerable, but there are other companies out there that still have sizable Chinese exposure. In fact, in a lot of the consumer space as well. So,
it's true, and sometimes they have localized production, like a Caterpillar, so it makes it easier then to sell, so the trade tariffs are a little different. Anyway, really interesting conversation. Well, we will continue to count you down to the closing bells. Paul Christopher, Head of Investment Strategy over at Wells Fargo Investment Institute, will be joining us. This is The Close on Bloomberg.
This is the countdown to the close. Romaine Bostick alongside Alex Steele. With 10 minutes until we get to the closing bell, starting to see a little bit of a fade in the action here. Alex, looked like we were setting up for new all-time highs here, but a big pullback in the S&P, the NASDAQ. The Dow just barely holding on to its gains.
I know. The Dow, I think, is going to close at a record, so we got one thing going for us there.
Sure. I got a 40,000 hat. I need 40,000.
Yeah, I understand.
Alex, not just a record.
I totally get it.
Otherwise, this hat was for nothing.
It just deteriorates. We threw confetti in radio when it first happened, which is very exciting. But again, I go back to kind of the dynamics of the Dow.
How did our bosses feel about that?
What?
How did our bosses feel about that?
I don't know. We got it on YouTube. You can check it out on YouTube. I just want to point out that Russell, though, underperforming yet again. Down 0.6%. I say yet again because whenever we see a downdraft in the S&P, the Russell kind of follows. And, if you're going to broaden out, let's see if the Russell can really hold up here. I'm thinking 40,000 tomorrow again. This is what I'm thinking.
Yeah, and we should point out, too, I mean, even though we are seeing red on the screen, when you look at some of the elevated levels, the near record highs that we're sitting, it raises a lot of questions about whether you reallocate. Do you underweight equities and move into something else? We had a chance to catch up with Mimi Duff just a little while ago over at GenTrust and asked her why they shifted to underweight equities.
We still have healthy allocations to equities. We're not missing this rally. We do feel that the overweight in fixed income will perform better in a range of outcomes if the economy does trip, or frankly, if we just continue to steady ahead, as we have seen. We think you're going to earn those yields on the fixed income side.
And that was Mimi Duff at GenTrust, who helped kick us off to the close just about an hour ago. And here to help take us to those closing bells is Paul Christopher, Head of Global Investment Strategy at the Wells Fargo Investment Institute. And Paul, I mean, we're still sitting at near record highs for all the major indices here in the U.S. Is there a case to be made for further gains? Is there a case to be made for being overweight?
Oh, absolutely, Romaine. We've been overweight the S&P for a while, but we've been a little bit more selective in how we do that. But to the point of your question, yes, it does look, especially after yesterday's CPI report, it looks like the hotness is starting to come off just a little bit in CPI, and that's going to give the markets, I think, some more upside. What happens after that, though, is likely to be a little bit more chop. So we'll keep our defensive positioning for right now, but we're overweight the overall index.
When we talk about that defensive positioning, Paul, what does that mean? Does that mean big cap tech? Does that mean like traditional defensive sectors like healthcare? What?
Yeah, no, good question. We do still like the S&P 500, but we're not going to chase IT here. We're not in information technology. We're not going to chase comm services. We're going to go for sectors that don't maybe have as much sensitivity to interest rates and therefore inflation as those two sectors do. So we like industrials, for instance. So we like materials. We like healthcare and energy. Kind of a mix there. But all four, we think, have good longer-term prospects and will benefit from the turn higher we think that the economy is going to have a little bit later this year and into 25. But we don't want to play the momentum trade.
Hey, Paul, I'm looking at utilities. I love looking at utilities, funnily enough. Over the last few weeks, in May, it has been utilities the second best performing sector within the S&P aside from tech. Are utilities defensive for you? Are they a growth area? Do you like them?
Yeah, they've been defensive, but I kind of wonder to myself, we do broadly here at Wells, whether or not utilities are starting to get a little of that bid that we've seen going into industrials that relates to artificial intelligence. All these data centers need to be constructed. That's industrials, that's materials, and they're going to need enormous amounts of power. That means building out the electrical grid. And could be utilities are getting some of that bid right now.
Interesting. So in some ways it's defensive and growth in some kind of capacity. Do you think that what would wind up halting the equity rally? You said choppy. What would bring us materially lower at this point?
Oh, goodness. Any sort of black swans. I mean, we've already seen some escalation in the war in the Middle East. If that should escalate further, we think that would be a very obvious roadblock for the markets and send us lower. But I think more probably it's going to be something like inflation. That inflation report yesterday, not as hot as previous, but still not out of the woods on that. If we were to get another surprise pop in inflation, let's say next month, the May report coming out the middle of next month, that could set markets back a little bit. And so that kind of chop, waiting for the Fed to cut rates, waiting for the economy to finally finish its slowdown and hit bottom. We don't think there's going to be a recession, but we are looking for more slowdown. So either one of those two factors and a delay in the Fed, those are probably the most likely sources for the chop that we see probably going into the summer.
There's been a lot of talk about the focus of the Fed on the real economy, if you will, Main Street, if you will, Paul. But there's been a lot of talk also about financial conditions. You have a lot of Fed members, including Jay Powell, saying, well, financial conditions appear to be tight or at least restrictive enough to do the job on inflation. But then you look at the market pricing and you look at market action, things seem a little bit loose. And I'm curious as to where you feel things are right now and whether that's going to be, I guess, an aid or a hindrance to what the Fed is trying to do.
Yeah, I wouldn't want to cross the Fed chairman, but with respect, the interest rate hikes that the Fed has delivered to us have hit certain segments of the economy that are more interest sensitive. So the consumer, the housing sector, manufacturing, parts of manufacturing suffering under scarce credit and expensive credit, especially small businesses. You've seen the Russell 2000 underperform here. But at the same time, there's quite a bit of liquidity in the economy still, both from the fiscal spending of last year and the year before, as well as Treasury and Fed programs last year to support the banks, injected about $500 billion into the economy. And now the Treasury more recently shifting to bills instead of notes and bonds. That's shifted some more liquidity into the economy coming out of the Fed's reverse repo facility and into markets. And so when you get that kind of liquidity, yeah, it can support markets. It'll support narrow credit spreads, higher stock prices, perhaps even some more money going into gold, a stronger dollar overall. And so we still see signs that liquidity will be a support, will be a buffer for the market. We're not looking for a deep correction. We just think there's going to be some chop and probably some buying opportunities for clients who are waiting for some of those pullbacks.
All right, Paul, going to have to leave it there. Great stuff as always. Paul Christopher, Head of Investment Strategy at the Wells Fargo Investment Institute, helping us count you down to the closing bell. With just about 3 minutes to go, Alex, until we get to those bells. And I liked his last comment there about the idea of finding opportunity. And we've seen that a lot here. And we've heard that a lot from a lot of guests here that, yeah, maybe the broader markets maybe look a little choppy, but there's a lot of individual sectors and stocks that can be bought.
Yeah, and also choppy is not like a 5-10% downdraft either. No. Like, I find it really hard to create a scenario that's not a black swan where you see 10% down. Yeah, like even the dip before tax season was bought. Yeah, well, that's the other thing, too, because everyone's so obsessed about what the Fed doesn't. But even if we just stay here, I mean, the market's showing that it could handle that, right? Yes, absolutely. So why are you scared? I mean, not scared. You. I mean, in the royal sense. We? Yeah. I don't know. That's a great question because we're used to being nervous. I don't know, but it does feel like why wouldn't stocks just keep going up in some fashion? Like, yeah, it's choppy. Yeah, you got stuff, but why wouldn't you buy?
All right, well, right now looking at S&P down a fraction of 1% here on the day. Stick with us. We're going to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast. Scarlett Fu in the TV studio, Carol Masser and Tim Stenevik in the radio booth. Welcome to our audiences across all of our Bloomberg platforms, and that includes our partnership with YouTube. Coming off those record highs yesterday, Carol Masser, and coming off a Dow 40,000. I know you were ready to pop the champagne. You always have champagne there at your desk. But it looks like we're not going to close at that level unless there's a big rally here in the next 2 minutes.
Listen, the first hours, the 2 o'clock hour, 3 o'clock hour, like you get a record, you get a record, you get a record. Like that's been our theme all day. But it definitely feels like we're running out of some momentum here. But it's been quite a week if we just step back. Happy talk. Isn't that what Jamie Dimon calls? He's a little worried about all of this.
I was surprised to hear his more subdued tone in that interview that he gave. Hey, one thing that I have my eye on because, well, meme stocks are still a thing.
Are they?
Is the air coming out of these meme stocks? Yeah, these aren't two of my decliners, but still worth noting that GameStop is down 30%. AMC is down another 15%.
Yeah.
Was it, blink and you missed the meme stock rally?
I'm kind of surprised it lasted for more than a day as it was. I thought it would be one day and then game over. Interestingly, for a month in which, the adage is sell and may go away, for the S&P 500, you have every industry group higher except for energy stocks. They're in the red. And in the Russell 2000, you also have every industry group higher. Energy is the laggard there, but within the small cap space, they're up 2%, energy stocks.
And volume really picking up here also as we get into the close. A little heavy trading as we're moments away here.
Yeah, you're still seeing, though, a little bit of buying going on, selling going on in the Treasury space. The VIX subdued here on the day, down back around 12 here, and the dollar relatively unchanged on the day. As far as equities go here, we're not going to get to 40,000 on the Dow. In fact, the Dow flipping into the red here at the closing bell, 39,870. Takes a while for these numbers to settle, but not the 40,000 that we all had printed out our hats for. Down 0.1% on the day. The S&P down 0.2%. The NASDAQ composite down about 0.3%, and the Russell 2000 down 0.6% to close out the day.
All right, back to the S&P 500 overall. Kind of an even split a little bit. 224 names gaining ground, you guys, on this Thursday. 276 to the downside, so a little bit more of a slightly risk-offer trade, I guess you could say, a little bit. 3 unchanged here, Scarlett, but kind of an even split.
Yeah, and with the swoon in the last few minutes of the trading day, you have 10 out of 11 groups in the red. So let's just focus on the green spot right now. That is consumer staples, and that is Walmart primarily. In terms of laggards, consumer discretionary, materials, and industrials, each down by at least 2/3%.
All right, guys, let's get to some of the individual gainers, if we may. Walmart atop that list, number one gainer in the S&P 500. Wait, let me make sure because I thought it moved down to, number one gainer in the S&P 500, finishing just off its highs of the day, a 7% gain, surging, topping $500 billion in market cap for the first time. We know Street very impressed on their earnings, posting stronger than expected first quarter earnings, boosting its annual sales and profit forecast. And talking with our own Jen Bartoshis, just talking about, who the Walmart consumer is, folks. It's people making less than 100, some making above 100, but also wealthier. It's kind of a third split, if you will, among those different groups. So it's interesting how the customer, she says, has really changed at Walmart. So really interesting company. Chubb also among the top gainers in the S&P 500, number 2 gainer, finishing off its highs, but still a 4.7% gain. We learned yesterday, we all did the headlines, Warren Buffett's Berkshire Hathaway now has a $6.7 billion stake in Chubb, ending months of suspense over what its mystery position in a financial firm it apparently had been previously kept concealed in regulatory filings. And I know we've got some earnings, so maybe we go there.
Yeah, we got Applied Materials coming out. So earnings per share for the second quarter coming in at $2.09. That definitely did beat estimates. Also net sales beating estimates, coming at $6.65 billion versus estimates. Its semiconductor systems net sales also pretty strong, $4.9 billion. I mean, this tracks, right? Strong chips.
Yeah, and it's interesting, too, when they kind of talk about sort of what's driving this here. I mean, I think it's a little bit more broad-based than what we saw from some of the other chip makers. So it's not just about AI and, EVs, if you will, here. They're still kind of pushing the whole Internet of Things things as well as clean energy as well.
Yeah, and they mentioned all of that in the press release. Applied Materials has the most enabling portfolio. That's interesting. I've never heard that term. For chips that underpin tectonic shifts in technology, including AI, Internet of Things. Are we still talking about that? Electric vehicles and clean
I got to tell you guys,
that's funny.
I can't get my washing machine to connect to the internet.
Yeah, that's the Internet of Things.
It's not
You're
working.
missing out, Tim.
Why do we
Why do we need that? Why do we need that?
I don't know, but it's not working.
Great.
I mean,
So I don't even know why we need it because I can't connect it.
okay, well, fix that because I'd like to know why I need that.
That's what I would like to know as well.
They can charge you more money for the, internet-connected washing machine.
Toothbrushes
It
connected
still
to the
washes
internet.
clothes.
Why
That's
do we
what's
need an
important.
app to brush our teeth?
Still washes clothes. That's what's important. Hey, shares of AMAT higher by 0.4% right now. Second quarter adjusted EPS coming in above estimates at $2.09. Second quarter net sales coming in above estimates at $6.65 billion versus estimates of $6.52 billion.
All right. Can I just hit on yields for a second? Let me hit on yields for a second, guys, because it was a big move, and I think it's worth talking about. Is you look at the 2-year, yields are up by about 7 basis points, and I bring this up specifically because we broke through the 250-day moving average yesterday on that super solid buying, and now we're just back above those levels. So I think it's interesting that we're going to get sort of the range-bound yield momentum here, but higher yields not a problem for the equity market.
And I was looking through WERP earlier because I was like, given all that's happened this week and over the last week and a half, that there must be a huge repricing in terms of Fed expectations, and you're really not seeing it. I mean, it's just kind of like you have some tweaks around the margins, but for the most part, everyone still is kind of in the same camp that they've been in now, at least for the last 3.5 weeks.
Hey, I know we're still waiting on some other earnings, including Take-Two Interactive. In the meantime, I do want to touch on some of the decliners that I had my eye on this Thursday afternoon. Not any meme stocks, but I do want to talk about John Deere because it is the world's biggest farm machinery maker. Shares fell 4.74%. The company did reduce its profit outlook for the year. Annual projections missed the average analyst estimates. Actually, declining agriculture income pressured the company, and lower grain prices have left its customers, the farmers, with less money to buy those green and yellow machines that Deere makes. Also, Cisco shares, they reported yesterday after the bell. We saw shares pop in the after hours. They did close today lower by 2.7%. The company did give a solid sales and profit forecast for the current quarter. But shares fell after analysts noted that the company's 2025 forecast looks conservative. Under Armour also under pressure today. Actually, at one point was the lowest it's been since 2010. The company said it's restructuring and it's going through a transition period as Kevin Plank, who stepped down from the CEO role back in 2019, came back last month.
I've lost track of how many restructurings they've had.
I know. Yeah. Well, they gave a full year outlook that also fell short of Wall Street's estimates too. So it's not just the most recent quarter, but also this huge restructuring that they're undertaking.
All right,
2010 lows.
Tough for Under Armour. Hey guys, I just want to draw your attention to Take-Two Interactive. Man, it's getting slammed in the after hours. All has to do with its forecast. Coming out and seeing fiscal year 25 net bookings, $5.55 billion to $5.65 billion. The estimate was much above that, $6.92 billion on the street. So yeah, some disappointment. Stock right now, Scarlett, down about 9.3% here in the aftermarket.
Yeah, and it's really on that forecast. The net bookings coming in lighter than anticipated. First quarter net bookings, $1.2 billion to $1.25 billion. Analysts were looking for $1.26 billion. For the full year net bookings, really coming in light. Also worth mentioning here that the fourth quarter numbers, the quarter that passed, includes a $2.18 billion goodwill impairment. I wonder if that is tied to Zynga and the purchase there and how that hasn't really played out for Take-Two. We already know that it said it's cutting 5% of jobs, it's streamlining titles, it's really embarking on this cost-cutting program as it, of course, still moves forward with the release of Grand Theft Auto 6, which has now been narrowed, the release date to fall 2025.
They do say those results, impairment charges, as you said, for acquisition-related intangible assets and business reorganization expenses of about $146 million to our cost reduction programs.
Yeah, that's interesting. I think we have to dig a little bit deeper into that. But I was just going through, too. I mean, we go through, because everyone's sort of obsessed on these launch dates here. Okay, so Scarlett's got her GTA in fall 2025, which probably means like summer 2027 here. But some of the other names they're listing, they've got a lot slated for fiscal 2025, which is really just right around the corner for them here. And that includes the new NBA game, the new WWE, Game of Thrones Legends, which I didn't know they were doing, and a couple others. But the question is, how are they going to get all this stuff out within that same time frame when they always have trouble just getting one thing out within that time frame?
That's a good question. Yeah. Maybe that's why the stock's reacting the way it is.
Interesting. I'm all for the Game of Thrones. What was it? Game of Thrones what?
Game of Thrones Legends.
Yeah, okay. All right, I can get on board with that.
Is the timing of that strange to you guys? the Game of Thrones game?
Why?
Because Game of Thrones was on years ago.
It takes a long time to develop these games, apparently.
Which I think is the point, because it takes so much money and long and time and talent to actually have to get the things up and running.
But yeah, I don't know. Obviously, I'm not in a position to make decisions on gaming franchises, but it just seems like that. I mean, I haven't seen Game of Thrones yet. I'm a little behind, but there you go.
Okay, dude.
I know there's
you
spin-offs
can't participate in this combo now.
I know. I don't. My washing machine doesn't. My washing machine doesn't connect to the internet, and I haven't seen Game of Thrones.
All right,
What's
guys.
wrong with me?
Are they related?
No. Maybe.
All right, guys, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. The team will see you again, same time, same place, tomorrow.
And we continue our coverage right here on Bloomberg Television. When we come back, we're going to go live out to Hawaii. Salesforce CEO Marc Benioff set to sit down with us for a quick conversation. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. And Scarlett, did you print out one of those Dow 40,000 hats?
I knew better than to do that.
All right. Well, you need to keep it in your locker, at least for another day here. We did trade above that level for the first time in history. As you can see, we did not close there. In fact, the Dow flipped into the red as you got closer to those closing bells. Down 0.1% here on the day. No real fundamentals here right now. We're really just talking about a market, just trying to figure out what the next step is going to be by the Fed. And you see there at the bottom of your screen that uptick that we saw in yields today, a 7 basis point jump in the 2-year yield. You saw similar moves across the other parts of the curve that really hit the interest rate sensitive sectors pretty hard here on the day. That includes the home builders, which as a group were down about 3% here on the day. But the bright spot here was in Chinese tech stocks. We saw 13F filings from folks like David Tepper, from folks like Michael Burry, piling back into that in a big way here, maybe around the margins in terms of the type of names that they're buying, but definitely a lot more conviction into that space here. That is the setup here on this Thursday afternoon, Scarlett. Meanwhile, back here in the U.S., we did have a few winners on the U.S. side.
Yeah, a lot of conviction in one of the biggest names in the S&P 500, and that would be Walmart, the world's biggest retailer, up 7% on the day. That is the most since March of 2020. It's unusual for a name like Walmart to gain this much. By the way, this is a record high for the company as well. It had a beat and raise quarter. Same-store sales rose more than expected, and e-commerce was also a big driver of growth. On the flip side, Deere, the farm equipment maker, dropping 4.75%. That is the biggest decline in about 3 months. This is after Deere cut its full-year profit outlook by at least $500 million. And at blame is falling farmer incomes, which of course leads to fewer purchases of Deere's expensive equipment. Not necessarily expensive, big-ticket items. All right, our top story this hour is what is up with Grand Theft Auto 6? When is it coming to market? Its publisher Take-Two reported earnings today and gave a release date of fall 2025 for the latest GTA, which quickly reset investor expectations for this fiscal year and next. Take-Two management, remember, last month announced plans to cut 5% of jobs as well as cancel several projects. The stock tumbling in after-hours trading. Romaine?
All right, well, we'll see if I can actually meet that date, Scarlett. Meanwhile, we want to turn to the world of municipals, and it is time for our Muni Moment with John Miller. His new high-yield municipal bond fund drawing in buyers eager to invest in the riskiest segment of state and local government debt. $1 billion of assets amassed in just 5 months. Pleased to say he joins us right now. He's the CIO and head of high-yield municipal credit at First Eagle Investment Management. First of all, John, I think congratulations are in order. I mean, I think when you sort of made this move, everyone knew you were going to attract a lot of money, but not necessarily that much so fast. What are you going to do with it, John?
Oh, well, thanks so much for having me. And we've already been deploying it. I think one of the advantages is the timing of starting in on this investment process with the capital that we've raised. We're near 16 or 17-year highs in the yield of high-yield municipal bonds. So we've been able to assemble it, invest it into essential service type credits that out-yield the competition with no leverage and no defaulted bonds and no low embedded yield bonds. Well, so that's been helpful in terms of timing.
Well, that's what I'm curious about here is the complexion of this, at least based on what you've publicly released as of March 31st. 63% of the bonds in that portfolio right now are unrated and 18% were below investment grade. You know, John, that's a bit of a contrarian call right now.
Sure. Well, really high yield municipals, including the non-rated segment, are a subset of the overall municipal market, which is a very high quality market. So non-rated doesn't mean they're bad bonds. It means that there may be some construction involved, there may be some ramp up involved. Ultimately, you're going to get to that monopolistic tendency of the essential infrastructure that benefits the community. That's the objective. And this might be a little bit earlier stage, and therefore some of the issuers go without a rating initially, thinking that they will get a rating 2 to 3 to 4 years down the road.
Also, unrated or non-rated means you're doing a lot of the legwork yourself. There's a lot of due diligence on your part. You've been called the king of high-yield muni bonds. What is the ideal size for a fund? Because if it's too big, you move the market, and you have to hunt for lots of different opportunities. Too little, and you miss out on some great opportunities as well.
Yeah, you're exactly right. The largest funds in high yield are in the $17 billion area. The mid-range is $8 to $10 billion. So I think if we're in the mid-range down the road eventually, if we're in that $8 billion area, we'll have enough capital to really structure unique opportunities and situations for investors, but still stay very selective in this niche asset class.
And Romain mentioned that your new high-yield muni bond fund has amassed $1 billion in AUM in less than 5 months. What portion of your buyers are long-term First Eagle clients who are largely new to this particular asset class, high-yield munis, versus just brand new investors overall?
We think that those are the top two categories that you just mentioned, both brand new investors and long-term First Eagle clients. I've spoken to kind of both categories of investors. I don't have the precise breakdown per se, but really this is complementary to what First Eagle already offers in terms of very specific targeted asset classes where they feel that alpha can be derived in an inefficient market, being a little bit different from the index and really delivering that alpha from individual security selection. So that fits the philosophy of First Eagle. So that's why it's a good fit within their overall portfolio and their overall base of clients.
I want to get some thoughts here on a couple of the holdings in the portfolio. Two of the biggest are Brightline, that's the big rail line down there in Florida, and another one was a casino in New York and an Arkansas steel mill.
Sure. Yes. Well, starting with the Brightline, many people are starting to know about the Brightline, but I would say it still needs more and more brand recognition over time, and will get more brand recognition over time. But they've accomplished a lot over the last 8 years. The system is the only high-speed passenger rail to be developed predominantly with private funds in the last 100 years. It goes from Miami to Aventura to Fort Lauderdale, Boca Raton, West Palm Beach, and the Orlando International Airport right now, for a total cost in the ground of approximately $6 billion because of a clever starting point buying Florida East Coast Rail. They actually carried more passengers than the Acela did in the month of March. So that's been a project that has had both some skepticism, but I think increasingly going forward, more and more fans are getting on board, so to speak. No pun intended. Another credit in New York that we've been involved in that you mentioned. There are actually two gaming facilities in New York that have been issued this year. One in upstate New York, the Oneida, and another in the middle of Suffolk County, Long Island, the off-track betting. In both cases, they're enhancing their venues for people who want to, say, gamble locally as opposed to taking the trip out to Las Vegas. And interestingly, in Arkansas, there's a project by U.S. Steel, and also there is a project by the same developers as the Big River project, which is called High Bar, and they're making rebar. So some corporate-oriented public-private partnerships can be issued on a tax-exempt basis when they're doing something environmentally favorable, like pollution control and waste disposal. That's how they issue those municipal bonds.
Got it. John, really appreciate your joining us. John Miller of First Eagle Investment Management with his high-yield muni bond fund. now $1 billion in assets under management. We had mentioned the results from Take-Two Interactive. They came out in the last couple of minutes. The stock is tumbling in after-hours trading right now after its outlook missed the average analyst estimate, also was lower than what people had anticipated. So joining us now with more is Louis Ward, ICD Research Director who covers gaming. And there are the numbers, and of course that is what investors are reacting to. But my guess is investors are just as much reacting to the release date of Grand Theft Auto 6, which will not be until fall 2025. Louis, let me ask you a really basic question. Why does it take so long to publish one of these games? We've been talking about this for a long time. It's been highly anticipated.
Right. Well, the game development cost for a game like this is in the hundreds of millions of dollars, and it takes many, many years. So, they had a strong base to work from in terms of GTA 5. And so I think at the end of the day, they want the production values high. It's probably going to hit, PS5. Or the next Pro version of the console is coming out with the higher specs, as well as the new Xbox console, which we expect to come later this year. So they want to make it look great and basically have legs for years on consoles, and then they'll follow with PC probably a year later.
Well, that's what I'm curious about, too, here, the gamble on consoles here. I mean, when you look at the industry, how it's evolving, and more importantly, how consumers use this stuff here, you see a future for consoles still?
Oh, absolutely. So, it's still huge in North America, Western Europe, Japan, and a few other countries around the world. A lot of people like the stability of those consoles, love the brands. And I don't expect consoles to go anywhere, or be eaten by cloud stream gaming or PC gaming or mobile gaming, particularly quickly over the next 10 years.
We know that Take-Two wanted to have exposure to mobile games, and it purchased Zynga, and perhaps that was not the right move down the road, given what's been going on with Zynga and how it's contributed to its bottom line. But do you see a future for a mobile version of GTA 6? I mean, is that something that they're actively working towards?
I don't know if they're actually working on a mobile version of GTA 6. I know that the current version, or the latest information I have, is that it's coming to consoles first, PC second. I wouldn't be surprised if they're noodling on how to make a variant of it available on mobile. I think that would make a lot of sense. I think Zynga, they did purchase it for quite a bit of money a few years ago. And I believe their advertising revenues have come in a little bit under expectations specifically. And so I think the part of the softness related to the Zynga acquisition is that the advertising market in a mobile context hasn't been performing as well as they anticipated.
There's been a lot of talk, particularly after the Microsoft deal, whether that we would see more big M&A, not just, of course, Take-Two buying smaller competitors, but whether somebody might actually be interested in buying Take-Two. Is that something at all you think investors should consider?
Not right now. I think Microsoft has a lot of indigestion, quite frankly, with the Activision Blizzard acquisition. Sony is not crushing it with the acquisition, a few of them that they've made over the years, including Destiny 2 maker Bungie. So I don't expect them to. Nintendo would be a real surprise. They generally don't do that sort of a thing. So that is not something I would expect near term to happen. I think they're busy chewing on a lot of assets that they already have, and they need to integrate with their existing systems. And so I expect that will take some time to work out.
Yeah. Also, do companies necessarily want to get engaged with regulators and go through another battle yet again? Louis, really appreciate your joining us today. Louis Ward of IDC on Take-Two's latest results and the fall 2025 release date of GTA 6. Coming up, we've got the top three. We focus in on the top three movers and shakers at the center of the day's big stories. This is The Close. It's time now for the top three. We take a deep dive every day at this time into the folks at the center of the day's big stories. First up, Salim Ramji, the new CEO of Vanguard. He marks the first time the fund management company has hired an outsider, which Romain means the age of Jack Bogle is over, and maybe the era of low fees as well.
Yeah, it'll be interesting to see. I mean, a lot's being made about this story and whether a guy coming from a company that he's coming from is going to really shake up Vanguard. I mean, look, they've established what they are. They have an identity.
They do.
It'll be interesting to see whether Salim fits that identity or whether maybe Vanguard shifts to him. Someone else I've been keeping an eye on is who else? Beyonce. We talked a lot about her tour last summer, and we're still talking about it now because it's showing up on the presidential financial disclosures of Vice President Kamala Harris submitting her financial disclosures, which showed a gift of about $1,600, which were apparently were tickets that Beyonce gave her and her husband.
What kind of seats can you get for that amount?
Well, that's pretty good. If it was just 2 tickets, and that's $800 per seat. I don't know. I went to a Beyonce concert. We had pretty good tickets. They weren't $800, so I think their seats were better.
And Beyonce
than ours.
didn't give it to you either.
She did. No, I know. I had to pay out of pocket.
All right. The last person I'm watching is Pierre Audurand. He is the commodities trader, and he is warning the world may run out of cocoa, which is the main ingredient of chocolate. Now, he is talking in his book because he went long cocoa futures in early March, and we know the prices have surged. But he talks about a cocktail of bad news for cocoa: bad weather, climate change, scarcity of fertilizer, long-term underinvestment across major producers in Africa. I think I might have to give up chocolate if it's going to be this expensive.
Okay. Well, I'll let you in on a little secret, Scarlett.
Yeah?
I don't really like chocolate.
You and
So I'm already there. I'm just like, I think chocolate. Can I just say it? Chocolate's overrated.
No. I can't be friends with you anymore.
We're going to break.
Oh my gosh. No. This is The Close. Let's turn now to hedge funds and bring in our very own Hema Parmer. And Hema, you had a big story out this week. I loved reading it. It was about Weiss Multi-Strategy Funds, detailing how the firm went bankrupt. And it wasn't so much the performance as their spending and their costs. We do see funds close all the time, but this is not because some trade went south, is it?
Exactly. So what happened here, we see funds blowing up because of performance. Weiss's performance was only okay, but it wasn't painful. What was painful was the spending. They were overstaffed. They didn't let go of some performers, some portfolio managers that underperformed, which typically at multi-strat funds, you do see some letting go of that talent. They had netting costs. So what that means is when the fund was down, they don't get performance fees. But they still have to pay out their talent that did perform and pay out their bonuses. And that can be quite expensive. And that's why so many hedge funds have pass-through fees. But Weiss did not have the pass-through fees.
I am curious. First of all, is there a reason why you didn't just pick up the phone and call Izzy Englander and say, help a brother out here? But I am curious about the talent side here, because I thought it was kind of intriguing about how they held on to some of that talent. Why? Do we know why?
Well,
were they just fearful they couldn't replace it, or what?
Some of the talent was long-term talent that had been there for a really long time, and so there might have been some reticence to let go of people that had been there for a really long time. But there were a lot of concerns over how much they spent. And in this, we talk a lot about the talent war in this industry, and especially when it comes to multi-strategy firms, you do see this really hot market, and you see, really very high pay packages. You see a war for talent where the PMs or the analysts sometimes can demand higher pay packages, and the multi-strat firms, because they've grown so much in terms of their assets, they need managers to put this money to work, and so they will pay out for them.
All right, Hema Parmer there, who covers this better than anyone else. And we want to stay on this topic, particularly when it comes to firsthand experience and what's going on in the talent wars out there in the hedge fund space. Ilana Weinstein joining us right now. She's the founder and CEO of IDW Group, which focuses on placing senior hedge fund and business professionals across the investment landscape. We should also point out that Ilana, later today, I think, is receiving the Harvard Business School Entrepreneurship Award tonight. First of all, congratulations on that.
Thank you.
We're going to come back to that.
Okay.
But I do want to start off on what Hema was talking about, which is really kind of what the churn is right now for talent out there, because we've heard so many anecdotal stories, people being poached from one shop to go to another. We've heard about some outrageous pay packages. What is the reality on the ground right now?
Well, I want to pick up first on one thing that you asked her about, which is why Weiss hung on to talent. I do think for many funds, there's a tendency to hang on too long. Not necessarily at the multi-managers, but in general, a lot of the single managers or other funds do have a tendency to worry about how that will look to LPs. And it'll destroy the culture, what have you. But you need to be really thoughtful about how you bring talent in, and also giving them the tools to be successful and when it's time to let them go.
But on the issue of retention, of retaining some of those managers, I mean, if the performance isn't there, and it's very obvious that it isn't there here, I mean, what becomes a threshold for when you finally say, or when the bosses finally say, we need to cut this person loose?
Well, I mean, honestly, the P&L that they're capable of putting up or not putting up. And there needs to be time to help them transition and learn, particularly with a more junior person, help them what I tend to call have a couple of scraped knees and evolve from that. And give yourself a chance to get a return on the investment that you've made in that person. But after a certain point, you just need to make the decision to let them go and let them go somewhere else that maybe they'll be more successful.
It goes back to the idea that for these firms, their most important assets are their talent, are their people. Of course, there's an FTC ban on non-compete agreements, and that's got a lot of companies really pushing back, first of all, but also rethinking how they're going to do things. What does this mean for the hedge fund industry in particular?
That's a great question. There's a lot of talk about it. I think at the end of the day, it's questionable whether it will actually come to pass as a ban, as a complete ban. There are appeals, and I think what will end up resulting is a more watered-down version. But the industry will adjust. The same way it adjusted to having non-competes, people just waited, and guarantees were extended to reflect the sit-out period. It'll adjust, and maybe what it means is the cost for talent will be lowered because people will be able to start right away. But at the end of the day, I think that what drives these guarantees is more about the dearth of talent than the length of the sit-out. So my gut is they'll become more front-loaded. But there's one important point I really want to make. This is a ban across everything, okay? Right. It doesn't really work for our industry, Scarlett.
Why not?
Because if you think about what the ban is predicated upon, it's two things. It's one, that non-competes stifle innovation. If you can't work, you can't start a new business. And the second thing is that it makes you unhireable. Well, guess what? The biggest hedge fund launches in the past half decade have been individuals who come from firms with non-competes. In some cases, quite sizable non-competes. It certainly didn't hurt them. And with respect to being unhireable, as I said, the industry adjusts and waits. You can't be competitive and say, I'm just not going to wait, and then the most senior people out there tend to be the ones that have the longest non-competes. But the big issue, really, is how this is unfair to employers. Because when the best funds are hiring someone, it's not just the guarantee. It's the tools, the training, the corporate access, the data, the mentorship that they're giving them. And then that person says, what, thank you very much, leaves, hoovers that all up and goes and competes.
But isn't part of the argument, though, too, is that there are already a lot of provisions in place that would prevent somebody from walking out the door with a lot of the proprietary information and even some of the training that they get. There are certain things that they can't necessarily take with them out the door already based on what the law.
Well, there's legal remedy for if you're taking proprietary information. We already have that. I'm saying something different. I'm saying we're taking you. Yeah. We're taking all the raw DNA that you are, and we're going to make you better. We're going to sit with you. We're going to give you tools. We're going to give you a mirror as to how you invest. We're going to tweak this. We're going to tweak that. We're going to make you the Superman version of yourself. Right. And then all of this time, all of these resources, that's not so much proprietary information. It's more the firm's investment in making you the best version of yourself. And then what? You're just going to, you say thank you and leave. I think what will end up happening is funds will find different ways to have alignment. If there aren't non-competes, we'll see bigger and longer clawbacks and longer and more comp getting deferred, which isn't necessarily a better outcome.
So is this why we're starting to see a lot more guarantees for talent? Is that tied to the non-compete ban?
No. The guarantees have been happening for a long time now. What the guarantees, and there's always been a competitive bid for talent. I think what has supersized it is the capital that has flown into the multi-managers off the back of poor long-short equity performance, where LPs said, okay, this isn't working for me. Let me give all this capital to multi-managers who will manage capital with less volatility, protect capital in choppy markets. And the reality is the best funds, the most developed, most evolved funds like Citadel and Point72 were either closed, and a number of others, but there really are only so many in that very rarefied category, or not really accepting capital very much. And so the capital flowed to other, let's call it incumbents, that grew between 3 and 8x in a 2-year period. And that really was, I think, what put more fuel on the fire of needing to hire and the guarantees that followed, which in some cases are not based on the reality of what the person is capable of producing.
Yeah, it's all that demand driving the prices higher. Ilana, always great to see you. Ilana Weinstein is founder and CEO of IDW Group. Congratulations to her for receiving the Harvard Business School Entrepreneurship Award tonight. Let's take a look at how markets closed on the day. We thought we were going to get a 40,000 Dow. We didn't quite get there, down 0.1%. The bond market, you can see their yields rising, so a bit of a reversal from yesterday, and oil prices inch higher by 0.9%. Still within a range, however. This is the close. Marc Benioff is up next.
All right, welcome back to the close here on Bloomberg Television. A focus right now on Salesforce, of course, one of the biggest cloud-based software companies out there. We want to go out to Honolulu, Hawaii, where the CEO of Marc Benioff is standing by with Emily Chang in San Francisco. Emily, take it over.
Romaine, thank you so much. And Marc, thank you as always for joining us. You are at a big groundbreaking ceremony today at Straub Benioff Medical Center in Honolulu. This is just one of many hospitals that you've now contributed to in Hawaii. And if I got my math right, this gift means you have given now $450 million to healthcare in both Hawaii and San Francisco. Talk to us about the thrust of these hospital gifts. What are you really trying to achieve here, and how does it fit into your broader philosophy?
Well, I'm so grateful to be here with you today, Emily, and it's wonderful to be here in Oahu. I think this is your hometown, is that right?
It is, yes, indeed.
And I'll tell you, we're doing something exciting here. We're breaking ground on a new hospital, which is the Straub Benioff Hospital here, and we just broke ground 2 weeks ago at the new Hilo Medical Center, and I'll tell you, it's great to be doing philanthropy in Hawaii. We've done it for so many years in the Bay Area, as you know. We've built 2 amazing children's hospitals in San Francisco and Oakland, and now we're bringing that great expertise here to Hawaii as well. It's really an incredible trinity that we've created between Hilo, Oahu, and also UCSF. And bringing it together, well, this is going to improve the health of Hawaiians. That's what we're all about.
Talk to us about the connection between the hospitals in Hawaii and San Francisco, because I understand now there's an ability to share care and share information, and improve the quality of care that folks get in Hawaii.
Well, Emily, as you know very well as a native Hawaiian, that when you're here in Hawaii, especially if you're in a neighbor island, you're living in paradise, but you also realize you might have made a trade that you may not have the same level of health care as you might have, for example, where you are right now in San Francisco. Well, we want the best of both worlds. We want the idea that you can have great health care here in Hawaii and also live in paradise. And the way that we're doing that is not only creating state-of-the-art medical facilities and recruiting world-class physicians here to Hawaii, but linking UCSF and also these Hawaiian hospitals together. And that's absolutely critical because look, we're going to be able to do great things here, but there will be limits, of course, to what we can do in Hawaii, which is why the integration with UCSF, which is, of course, the University of California, San Francisco, probably the premier medical center in the United States, is now part of Hawaiian healthcare.
You've talked for many years about the requirement, really, responsibility to give back when you can, and you've talked a lot about folks not giving enough in the San Francisco community. In Hawaii, you've made a number of property purchases, as have a number of tech billionaires like Larry Ellison, who now owns almost all of Lanai, and Mark Zuckerberg on Kauai, and Jeff Bezos on Maui. Are all of those people giving enough, doing enough to give back to their communities?
Well, different people who live here like to do different things. Some people told me that I like to buy a lot of land here. That's preposterous. I have not done that. I don't own hundreds of acres. I did buy hundreds of acres for an affordable housing agency in Hilo. So that is some land that went to help Hawaiians get homes. But I'm very happy just having my own personal residence here. But what I really enjoy is giving back. And I think you know that in the Bay Area, not just through Salesforce that's given back, hundreds of millions of dollars in the Bay Area, including being the largest provider to the local San Francisco and Oakland public schools, but also to the hospitals. And this is so important to us that we can give to our local public hospitals, our local public schools, even our local public parks. I think all of us can do so much more to give back. And it's probably the most fun I've had as the CEO of Salesforce. I mean, it's been an amazing journey becoming the third largest software company in the world. I think we're going to, we said we're going to do about $38 billion in revenue this year. Well, that's been an amazing journey, but the fun part has been giving back. And that's why I continue to do it and why we're going to continue to do a lot more of it in the future as well.
Well, since you mentioned it, you've now been back, quote unquote, as sole CEO of Salesforce for the last 18 months. You weathered activist investors. Talk to us a little bit about the learnings in terms of retaking the reins in the age of AI.
I think I might be one of the few CEOs that actually really enjoyed working with these activist investors. I had never heard so many great new ideas in my career, including such out-of-the-box thinking. And look, we were able to really transform and evolve Salesforce over the last year, and you can see it with our incredible financial results that we had last year and our idea that we're able to continue to move forward with these incredible new characteristics of our company. In our last earnings result, we even talked about that we've started to create a dividend. That's something that was beyond my imagination even just a few years ago. So it's exciting to be the #1 CRM, to help companies connect with their customers in a whole new way. Right now, we're about to enter an incredible new world, which is the world of artificial intelligence and how it's going to transform these customer relationships. And I think we're about to see some technology that we never thought we'd see in our lifetimes. We're going to see just some incredible new ways to run our businesses.
Competition in CRM is fierce, Marc. You've got ServiceNow trying to poach a bunch of Salesforce employees. I believe they stopped using Slack after you bought it. They're trying to build more of a consumer brand. They started their own Trailblazer program. Are they trying to pick a fight with you?
Well, they're an interesting company. I just think they need to be careful. They might be getting a little ahead of their skis. We just replaced them at Disney. Of course, we already had run Disney stores and Disney guides in the park, and we had done a lot of things with Disney with their customer relationships. But I think everybody knows that when they went to have Disney Plus and wanted to have a call center, and they chose that company, well, unfortunately, Salesforce had to come in and rescue the entire operation and rebuild all of the customer success and call centers for Disney, and which was at that point had been called out as a marquee customer of theirs. Well, Salesforce is actually a tremendous company that does real customer success and delivers solutions in sales, service, marketing for so many great companies around the world now. Obviously standardized at Disney, but for so many other great organizations, banks, insurance companies all over the world, and I think we're doing pretty well on our own.
Alphabet and HubSpot, Google and HubSpot are in talks to merge. How significantly would that disrupt the CRM market?
Well, I haven't really heard too much about that. Obviously, these are both great companies and customers of ours, and so we work with them very closely, and it'd be very interesting to see what would happen, but I really can't understand it because I actually have only heard the rumors that you've heard.
It's Bloomberg reporting, but we'll leave it there. Last question. I'd love to ask you about TikTok, if I may, because you've been such a vocal critic of social media and its impact on children, its impact on people. I'm curious what you think of the TikTok divestment law, and if Salesforce would be at all interested in joining a coalition of companies interested in buying TikTok.
Well, we're not really a consumer company. We drive a lot of these consumer companies, so many of them are our customers. I know that that's been an amazing journey, but I think that when it comes to social media, and I've said this before, we have to look very seriously at how it's being managed and how it's being regulated. There's certain U.S. regulations that kind of give these social media companies a free ride, even if their platforms are misused. I think that needs to be directly addressed. I've talked about that, I think, with you several times. And look, this is a serious world. And you talked about AI. AI is going to be able to create a lot of misinformation, and if we don't have a good understanding of how that's being used with social media, we could end up in a place that we don't want to be. You know, I'm a huge proponent of free speech, but I am not a huge proponent of all speech. You know, I don't think that the ideas that hate speech or misinformation should really not be tolerated in some of these platforms. It's not tolerated at Bloomberg, it's not tolerated at Time or other media organizations. It shouldn't be tolerated on these social media networks as well.
All right, Marc Benioff in Honolulu. I'll let you get back to that groundbreaking ceremony. The CEO of Salesforce, Marc, as always, thank you so much for joining us. Romaine, I'll send it back to you.
Thanks there to Emily Chang and, of course, to Marc Benioff, the CEO over at Salesforce. Got a little bit more coming up here on the close. We're going to set you up for what to watch over the next 24 hours. Stick with us. This is Bloomberg. All right, as we wrap up today's show, let's push ahead to what folks are going to have their eyes on over the next 24 hours. And we start out over in China, where we get a lot of data coming all at once.
Yeah, whether it's retail sales, industrial production, or property sales numbers. The interesting thing here is Caixin, a Chinese publication, is reporting that Beijing may announce some policy measures related to the real estate crisis.
Well, yeah, and there's been a lot of speculation on that. Of course, Bloomberg has been reporting on some of the measures that folks think they could take. And then meanwhile, we also get some more data over in the Eurozone on inflation.
On inflation, and of course, inflation there is falling faster than it is in the United States. So the ECB has seen reaching its target earlier in 2025 than people had anticipated.
Does this mean they start cutting before Jay Powell starts cutting? All right, well, we're going to find out. And of course, we get a big shareholder meeting tomorrow. We don't always pay attention to shareholder meetings, but this one's involving Boeing, so potentially some fireworks.
Yeah, and it's going to be led by the chairman, Steve Mollenkopf. And of course, the big issue here is where are they on the search for a CEO? And they'll likely go outside the company, since all the criticism is that the corporate culture needs to change. Maybe it's broken.
And the question is, though, who do they pick, right? I mean, because everyone says, well, I mean, when I saw some of the names that were floating around, I was like, isn't that just basically the same person that you already have here?
Yeah.
Do they need somebody who's basically like a pilot or an engineer or something?
It's a complicated company, right? Because they make these big airplanes. There's safety considerations. It's a complex engineering company overall. I mean, you have to look for a specific kind of person. So, yeah, it's a big question. Also, some of the directors face resistance as well. Glass Lewis recommending against re-electing them to the board.
All right, we're going to keep an eye on that. We'll have full coverage of any results out of that meeting. We're also going to get some more Fed speak, Scarlet Fu, if you want it, including from Mary Daly at the San Francisco Fed.
Yeah, and of course, her reflecting on the CPI data that showed that inflation does appear to be slowing down.
Does appear to be slowing down. A bold call there. Here, thanks for joining us. We'll be back tomorrow, right here on The Close. Balance of Power coming up next here in the U.S. This is Bloomberg.